keep listening to this term now more, operator turn VC. Can you explain that term, and would you also classify as that?
You don't have the empathy of what a founder goes through, which I'm candidly telling you, outside in you can say you have, but you'll never understand enough of.
Running a VC fund is actually dhanda, right? Like you have to think through all of those aspects. It's about actually creating a business, running a business while you're running a fund.
It's not a 1 year, it's not a 2 year business, it's a 10-year business, right? We are going to be deeply embedded, with that founder and with that company for a very long period of time.
What you see as fund managers, how hard it is to even get started.
So SEBI sets aside a minimum of 2.5% or 5 crores, whatever is lower, is what you have to invest.
You need to have adequate skin in the game. For example, in our fund, while we are mandated by SEBI to put in 5 crores, we invested upwards of 20 crores of our own money in the fund to really demonstrate, equal skin in the game, as compared to our investor.
If you can describe the persona of an LP, if somebody is considering to invest in a fund, how much money they should have?
If you are a category 2 SEBI registered fund, SEBI sets out a minimum accreditation that an investor needs to have. And so in the case of a Cat 2, it's a minimum 1 crore. The reason for that is because
to get our season started, Ankur, heads Spear Capital, and he's been on the consulting side before, and so he knows both sides of the coin pretty well. So thanks a lot, Ankur, for coming in. Would also give you a chance to talk a little bit more about you and your fund. And we also have Himanshu. He's right now helping a lot of funds with different aspects, and they have a very interesting model which I would want Himanshu to talk more in detail about. But since he's been a founder before as well, and now on this side we have now people who pretty much have seen both the sides, and that's why I'm super excited for this discussion. And thanks a lot, Himanshu, to you as well for joining in today.
First of all, congratulations on the success of Karnama. I think it's been an exciting season for everyone who's been involved and the viewers too. And really excited about your second season of podcast here.
Yeah, no, I couldn't agree more, Chetan. I'm envious I didn't get the opportunity to do this in the car, but I'm hoping it hits
we'll still do that
soon, and we'll have the opportunity of doing it. But I think just love the manner and the format in which it's been done. I think it just is going out of an office, going out of a room, just doing it in such an informal manner. And I don't know you, but you convinced Himanshu to drive as well, which was very interesting in that episode. So
Himanshu was actually more than driving; he was test driving the car as well. That time I was like, okay, I'm looking to buy a car. Why don't I drive? Like, why don't you go ahead? I don't mind just talking. So, but yeah, it was fun. It was informal, and that was the intent. That founders as well see VCs as very unapproachable. They are also humans at the end of the day. So I always wanted to bring that personal angle out, right? And guys, not a disclaimer, but we want to keep the fun here as well, even though we are in the room. And think about those songs also you might sing. तो वो कारनामा karaoke फिर भी हम रख सकते हैं. So that later on, but yes, we want to keep it very free flowing. So that was the idea. So Ankur, why don't you talk about about you and the fund to start with? Why did you even start the fund in the first place?
Yeah, actually, let me talk about more interesting thing about the fund. My background is fairly boring, but in 10 seconds of that, as you said, I spent 25 years in consulting between Anderson and then with EY. I think I've sort of fell in love with the early stage ecosystem when I moved to Bangalore in 2008, and I think I spent my entire time sort of working with startups, and it was a great time because that's really the time when the ecosystem was just started, evolving, right? Flipkart, the VC ecosystem just started to evolve also in 2008, 2009. So I think it was just, serendipity, luck by chance that, got me there, and I started to work with the startup ecosystem. But I think for me, after having spent all this time, in transactions, in M&A, and working with sort of, companies in this entire startup to scale up journey, I think for a lot of us, I think COVID was an inflection point of figuring out really what matters, right? And who we are and what's the impact we are making. And I think that I was going through that moment, in my life as well, starting to see, what am I doing that's sort of creating an impact, and all the 20-25 years of learning that I've got, how do I put it to better use? And that time it wasn't about a fund, it wasn't about should I go out and start up, but it was more about how do I do more of what I'm doing. I've also been an angel investor since 2014-15, and I've seen the startup ecosystem very, very closely, right? And both as a consultant trying to raise money for people, being on the other side when investors are putting money in startups, and I think the learnings of both pain and success, I think, are very deeply embedded with me. But for me, I think as I started to think about it, my two other co-founders at the fund, Rohit and Karthik, I actually met them through my professional circles as well. I know Rohit when he raised his first round of capital. Rohit is was the co-founder of Cloud9 Hospitals. He raised his first round of funding in 2011, which is when I got to know him, and we became great friends and sort of started to do a lot of work together, started to angel invest together. And I think just such a wonderful person as well. And I think it was just great to be able to sort of start building with him together. My other co-founder Karthik was at IDG Ventures, which became Chirate subsequently, and coincidentally on his first deal that he did when he joined the venture business, I was sort of working with the company where he was an existing investor. So I think some of these relationships sort of came through over a period of time, but the three of us were thinking about the same thing, the same problem that we wanted to solve, which was really take the conversation away from capital, right, in this startup ecosystem, and sort of take it to what is more meaningful. And the way we thought about Bear Capital when we came together really was that when financial capital marries intellectual capital, and that's what creates valuable capital. So our entire thesis is around valuable capital, and the financial capital is table stakes. The intellectual capital comes from the three different experiences that we have, which is Rohit having been a founder and an operator, moving into the investing side, Karthik having been an investor all his life, and me coming from a to startup to scale up consulting and having done M&As. I think the strong conviction really came was that honestly the value is actually in our differences, right? And that's the strength that we actually have, and we sort of came together to start Bear Capital in 2022. 2022 is when we launched. We applied for a license in 21, etc. But I think it was really to have a deep impact on the ecosystem that we really loved, that we've been part of pretty much from the startup ecosystem in many ways. And really it was a tough decision, I must say, because all three of us were really in our respective careers and where we were for the longest of time, right? I spent 25 years. Karthik was in IDG/Chirate for 12 years. Rohit founded this business in 2016, so pretty much 15 years in the same place, in the same business. So I think longevity obviously tends to have both benefits and sometimes hold you back. But I think we were very clear that I think we had done enough in our journeys. We wanted to go back to building 0 to 1, and that's honestly what got us together to build Bear Capital. We're a 50 million fund. We are really picked the sweet spot of doing sort of seed to pre-series A, from an investment size perspective, and we picked themes and portfolio construction that really marries our beliefs and interest, and that's how we picked sectors that we sort of look to invest behind, and therefore also the sort of portfolio construction that we want to do. But we can talk more about that. But we've been around for 2 years now, invested in about 13 companies. We'll do about 10 more from this fund.
Yeah, that's amazing. And before I come to Himanshu, we keep listening to this term now more, operator turn VC. Can you explain that term, and would you also classify as that, operator turn VC? Why is that important?
No, so absolutely. So I think why operator turn VC is important, and going back to the point that you made previously, folks who are in, and I say, I think I'm generalizing, but I would say, broad stake, it is going to be that. Most people who are consultants, McKinsey's, BCG's, large firms of the world, bankers, So I think they had a good understanding of elements in many ways. But building a business bottoms up is a very very different animal to deal with. Right? I think the ability to understand the founder. Just because you built a business, I think your ability to understand the ins and outs of a founder, the sleepless nights that they have to go through, the problems that they have to face and handle. What does it take to build a business? I think I think consultants, bankers, all have seen it outside in. But building it inside out is a very, very different, pain point to have understood. Right? And that's why I think when we also came together, at Peer Capital, I think we felt very strongly that Rohit's experience as a founder, his sleepless nights, his learnings, his journey of having raised money from Matrix to Sequoia to TPG to Temasek, subsequently that journey and the ups and downs and many days when you don't even know what's next is very important when you think about a journey of working with a founder from a VC firm point, because this is a 10-year business. It's not a 1 year, it's not a 2 year business, it's a 10-year business, right? We are going to be deeply embedded with that founder and with that company for a very long period of time. And I think if you don't have the understanding, if you don't have the empathy of what a founder goes through, which I'm candidly telling you, outside in you can say you have, but you'll never understand enough of. I think that's why founder-led VC firms are super critical. But I will caveat this also. I think only founder-led VC is not good enough either, right? Because there are many other skill sets and requirements and needs that come in to build a venture and to build a fund, more important, right? And I think that's why you need different points of view, different skill sets to create, an outlying alpha. I think that's why I said, right? I think your strength is always in your differences, it's not in your similarities. And that's why we feel, at least for us, and I'll speak for ourselves, we feel we've got the right mix between ourselves to make sure that whatever a founder needs in a 0 to 1 journey, between the three of us, we have the ability to provide that. Standalone, one of us, either one of us would not be as powerful as the three of us are today. And that's where the compounding alpha, we believe, actually comes from. But I think founder, operator in the VC ecosystem, more and more is happening for it. I think more power to them, super important, super critical. I think that's where the real dhandas will get understood, and that's where the real dhandas will get built. And that is where returns for funds going forward will change. At least the hope is will change much more than what they've happened in the early vintage of VC.
Sure. No, I think very interesting. More segues to come for sure from this, but I want to get Himanshu first, talking about team as well. Himanshu, firstly, what are you building? What is the team like? If you can talk about Oyster Global.
Oyster is India's premier alternative assets manager. We combine robust diligence, deep domain expertise, and an extensive network to create high-quality private market opportunities available to our investors. With about an average of 18 years of work experience in private markets by each of our founding team members, we understand the ins and outs of private markets to be able to bring forth some of the best opportunities for our partners and investors. And over the last 2 years, Oyster has introduced about 6 funds and invested in about 50 plus startups through them. Our key motto is, if it's an oyster, it's a pearl, right? This guiding principle reflects our unwavering commitment to excellence and quality. Just to give you an idea, India has about 1500 odd AIFs, and out of them, diligencing and shortlisting 6 odd funds till now for investments will show you the kind of diligence and the kind of selection shortlisting that we do to be able to come up with the best opportunities for our investors.
So basically, the funds also, at the end of the day, have to get money from somewhere, right? For the audience, just trying to also simplify. So you are investing into those funds, but as a concept, as an idea, has that never existed in India, and how popular it is outside India? If you can talk about that.
Yeah, so in India, actually, a model like this has never existed. In India, typically, let's say an HNI, if they were to invest, either they were going directly to, let's say, fund managers like Ankur, or they were actually going through their advisors or wealth managers, etc. But they were directly getting into the fund.
right? I mean, through Oyster, what's happening is Oyster is a SEBI registered category 2 AIF. So investors invest with Oyster, and Oyster then further invests as a single check into the selected fund, right? So essentially, there is as a fund manager, Ankur is then not, let's say, managing 150 odd limited partners, right? For Ankur, Oyster becomes the only limited partner or the investor. So that's the differentiated factor. And yeah, I mean, in the West, actually, there are a lot of popular platforms or models like this. There is a company called iCapital, which is about more than $180 billion in AUM. There is another company called Moonfare. There is another company called Alta. A lot of such similar companies which are doing very successful. I mean, the playbook is actually tried and tested because it solves the problem for both a limited partner as well as for a general partner.
Sure. And there's also a concept called fund of funds, right? So I'm assuming obviously that is different than what you are doing. But can you talk about the difference and the nuance there as well?
Typically, fund of funds, what they do is they sort of take in capital from LPs and then they decide their strategies, where to invest, right? All of that. I mean, at Oyster, we never offer any sort of blind pool investments. What it means is, let's say, whenever Oyster is investing, the investment entities or the targets or the funds are always pre-decided, right? So which means that the investor knows that where the money is going to be invested into, right? So from that point of view, let's say whenever Oyster invests, it's always a known investment that the investor is, or the LP is actually coming to Oyster. And
Chetan, a good way to understand fund of funds, for example, would be like SIDBI in India, right? Which is a government government fund of fund. They have a 10,000 crore corpus that the government is giving them. So the SIDBI committees, etc., decide which funds they want to put in. So the allocations already come. They will decide. They will do similar processes like what Himanshu mentioned about doing diligence, but it's after the commitment rather than before. And in Himanshu's case, once they've chosen, is when they go out and get the commitments. But fund of funds, obviously, especially in the Indian context and especially with government, SIDBI, SRI, is a super important part of funds and fund managers, especially emerging fund managers, because it's a very important pool of domestic capital, which emerging funds and new funds find it hard to access international institutional investors. It's typically first fund, you will not get a lot of them. They have a certain process that they follow. So, but that's the nuance. I think what Himanshu is doing is one part, and what SIDBI, which is a classical fund of fund, does it like a blind pool structure.
Actually, Ankur, I would add on. In fact, one of the key motivations for us to start Oyster was to actually increase that domestic pool of capital which gets allocated to private markets. I mean, in India, like if you take last year, less than 15% of the capital that got invested into startups, right, was coming from domestic pool. 85% was foreign pool, right? I mean, if you just were to compare this stat with, let's say, a public market, right? In public markets, DIs and FIs are actually close to 1:1 ratio, right? I mean, I think FIs is 1.07 of DI. If in fact you pull in DI along with HNIs and retail investors, it's almost like 75% of the pool, right? I mean, in public markets, it's already sort of an inverse ratio, and we are very, very sort of hopeful as well as positive that very soon private markets will start to see that trajectory, and there has to be a few catalysts that help drive this change. So actually SIDBI, etc., they are like the leaders in this space, right? So, or the first movers in this space, I would say.
And I think that's also very important, because you mentioned the number of 1,500 sort of AIFs today, right? And I think a lot of the growth in AIFs for the last few years has happened because there is domestic pools of capital that are becoming available, which did not exist other than, let's say, institutional SIDBI sort of capital did not exist for a long time. So as more and more HNIs, family offices, folks like you are coming on, into sort of this category, I think that's really where the expansion of domestic pool is happening, which absolutely, I think, this entire Atmanirbhar piece, and for our ability to get to the ambition, 2027, 2030, 17, etc., I think a lot of this is really going to contribute. So I think it's fantastic that more and more, capital is coming in, and There are various catalysts, but good to have folks like you also sort of helping add to the powder that becomes domestically available.
And also want to add on, Himanshu, you mentioned that day, right? The lot of the money right now in the AIFs is coming from outside India, correct? I think you mentioned about 80% is coming from outside India, right?
Correct.
Correct.
And you're seeing that, how will the India's contribution to this grow? Like, what do you think should be done? Like, people who are investing into asset classes, HNIs, who are not aware of funds, should they be educated more? What are the other things that will be done so that, more money can come from India as well into the funds?
Absolutely, Chetan. I think you're bang on right. I mean, for us also internally at Oyster, the number one priority is education, right? It's all about education. It's all about making people understand how private markets operate, right? I mean, you'll be shocked. I mean, there are like people who are sitting on like great wealth, but they're not aware about the kind of performance that VCP funds operate at, right? I mean, they're not aware about which are the top funds. Right, so it's about firstly making them educate and understand how private market operates, right, and then obviously with the ecosystem, with the existing set of advisor network, right, expanding this awareness, this education to the right set of HNI investors, right. So I mean that's the number one priority, and obviously you need to have platforms like Oyster, catalysts like Oyster, who are eventually going out to these investors. I mean, if you were to just look at the upside, so see, I mean, there's a ratio of private market investments to GDP. India is sitting at about 1.2%. A developed economy like a US typically sits between 4 to 5%. China also is somewhere around 3.5-4%. So that upside actually is very, very significant, and it's right in front of us. I mean, it has to happen, right? We're just waiting for a few shifts, right? I mean, I think Ankur was talking about a J-curve moment, and we are already seeing that we're path or on the path of that J-curve, where the allocations start to move to private markets for one reason or the other.
So there's also a maturity curve for the industry, right? Let's keep in mind that the VC industry in India is only maybe 18 years old, and I'm saying 15. I'm just counting 2008 onward. It's been around from 2005. So. I think that is the other thing, right? As the maturity of the ecosystems, happens, as people start to understand this asset class more, as more classical, startups start to go public, where they get visibility from a financial point of view, right? And you see the number of startups that have obviously gone public, in the last couple of years and highly successful, and many more, in the pipeline. I think the visibility of sort of the returns that you can make from this is only going to increase. In the past, when it was much more, let's say M&A, it was much more, exit to a financial sponsor. The returns were sort of exchanged between one fund and the other. Now, public market can see ki, Mamaearth listed at XYZ premium. This is what's going to happen at Bula. This is what's happening at Zomato, right? So I think that is also increasing the awareness and the understanding. I think, and that will add more confidence and credence to the ecosystem. But look, I think the Zeitgeist moment is here, because if we have to grow as an economy, if GDP has to grow, if we really have to go digital, which we are already, if we have to talk about benchmarks of digital GDP to total GDP, we are far behind. So the movement is already there. Question is whether you want to get onto it now, or you want to get onto it when the finishing line is there. Obviously, valuations, point of access, all automatically change. So I think the catalysts are already in place. More awareness, more understanding and education that Himanshu rightly spoke about will go a long way in making this easier to understand. I think we need a mutual fund sahi hai moment for private capital and VC. Obviously, it has different accreditation needs. It's a longer term asset class, so it can't be as simplistic as mutual fund sahi hai. But I think it needs a moment like that. And I think platforms with the transparency, platforms like Oyster with transparency, with ease of understanding and deploying, actually will go a long way in enabling.
Yeah. And let's talk about that, right? Who are these people who would now become LPs, right? You're talking about they'll be LPs. So, in a very simple word, if you can describe the persona of an LP, starting from the lowest rung. I mean, because if somebody is considering to invest in a fund, after this conversation how much money they should have, right? So let's talk about that. If one of you can take, Ankur, why don't you start and then we can take Himanshu's thoughts.
Yeah, and I think we should get both perspectives because for us it's a single fund that has certain different sort of criteria in Himanshu's case because it's spread out. I think it's a great perspective to get on board. So firstly, let's look at what the regulatory side is, right? If we are a category 2 SEBI registered fund, SEBI sets out a minimum accreditation that an investor needs to have to be able to invest in a fund like that. The minimum accreditation, the reason for that is because this is a complex asset class from an outside perspective. It's a long-term asset class. It's a closed-ended scheme. You can't exit, when you want. Returns are not guaranteed. Returns will only start to flow through in cash form to you maybe 7-8 years, later. The transparency that this has versus what public funds have is very different, etc., etc. So there is a minimum threshold accreditation that in the case of a Cat 2, it's a minimum 1 crore. So that's the minimum quantum that someone has to commit, to a fund. The way it works is clearly that you make a commitment, but you don't draw the 1 crore on day one, right? There is a period of commitment and a drawdown that will happen, and that could vary fund to fund, strategy to strategy, but it could be anywhere, from 12 months to 24 months, or depending on the tenures that you set up. Now, the way to think about it, and going back to pools of capital, conversations, and that's where different thresholds obviously get put in place. So the lowest end would be, let's say, a 1 crore investor. It could be any form of 1 crore. It could be an HNI who wants to experiment. It could be professionals. It could be bankers. It could be consultants, lawyers, etc. It could be people who invest in the markets but want to sort of dabble in. So that would be, I guess, a large pool of mass capital which sort of can come in, but that's the minimum threshold. You look at upstreaming that to next levels. These will be family offices, right? Family wealth, family businesses, people who created exits in the past who now institutionalize it and run it like a family office. These are potentially larger checks in funds and firms like that, super critical as they come in. So that's the next level, that sits. Above that, would be your fund of funds, right? I mean, SIDBI is a classical example. Oyster is a classical example, and there are many other sort of similar structures that exist across. Above them would probably be foundations, right? I mean, like let's say like a Gates Foundation as an example. While they will not invest in funds across the board, but there will be impact theme sort of funds, etc. They would sort of invest behind. Then you've got the pension funds, right? These are largely global pension funds which allocate money across the world. And India is obviously the brightest spot in the global markets at this point of time, so they allocate a lot of money there. And then the endowments, right? Harvard, etc., Stanford, and those endowments, which largely education ones, would be the other one in the ecosystem that would be there. The two other, I think, newer forms of capital that we are also starting to see is, I'll say one, I can combine them together, is really strategic capital looking to make investments and get an understanding of the startup ecosystem, of the opportunities that exist, in funds, right? And these are, let's say, corporates or corporate venture capital vehicles of theirs who are becoming LPs to use as, sort of a thin edge of the wedge to understand what's happening in market, how the market is evolving, what's happening in the startup ecosystem. Some of it is very relevant to them to understand their business and how they will get disrupted, but also sort of to use this as an opportunity to learn more about the startup ecosystem to see how they should expand, right? Because a lot of conglomerates, also more traditional ones, are actually getting startupish in many ways, right? And this is a great way to understand that opportunity. So I think that's another newer pool of capital I would think is getting added to the ecosystem.
Got it. I think I don't know if you've left any profile or persona of the LP. So very nicely done, Ankur. Probably Himanshu, you can add on to any thoughts for LPs, but definitely want to also know the other term, which is GPs, right? Like, and what's the difference? And because we want to conclude this educative section, at least the terms should be very clear. LPs and GPs.
Yeah, so LP is limited partners, GP is general partners, right? So I think Ankur has very well covered the persona of an LP, but let's say somebody who's listening to it, if they were to understand what should be the allocation, etc. Like Ankur mentioned, it's a 1 crore minimum commitment size for the category 2 funds, and this 1 crore is actually the commitment. It's not like the first drawdown in most funds. Usually, let's say it's a 10-year usual fund size. I'm saying on an average, it's usually 10 years. 10 years also is spread across 5 years of commitment period. What this means is that this 1 crore is drawn over a 5-year period. So, and let's say if you were to just average it out, every year, if it's a 20% drawdown, then typically the investor who has committed 1 crore is investing, let's say, 20 to 25 lakhs per year, right? So the way, let's say, if I were to, or anybody should ideally think of, could think of rather, is you park about 10 to 15% of your total investable wealth, to private markets. Because what that ensures, because it's a closed-ended fund, like Ankur was saying, right? I mean, you want some bit of flexibility with the other 85% of your wealth. So, or whatever that percentage is, which you are comfortable to have in a logged period asset, you only park that percent. So I think that just should help a person to think through, like, who could become an LP, who should become an LP. But typically, like, after 1 crore, you're self-accredited. That's why, the minimum is set as 1 crore. Right.
Got it.
And the other term
I mean,
is general
that's
partner.
actually very helpful, Himanshu, because if we are thinking 1 crores, a lot of people who may be able to invest even 20 lakhs a year, I mean, that they might be open to it, but I don't think so a lot of people would know that, right? That you can actually be part of the fund by just investing 20 lakhs, which is like what, 1.5, 2 lakhs a month, right? And that opens up, a lot of opportunities to get a lot more LPs in. People who are even working, and employees of startups, maybe making 3-4 lakhs or 5 lakhs a month. They can consider it only if they know it, and then they also have to then obviously weigh in that how much returns this would give me versus FDs or mutual funds. You have to obviously think about that, but I think a lot of education is required for sure.
Just one caveat there, Chetan, is that while 1 crore is the minimum limit accreditation that SEBI sets out, typically as funds evolve, right, newer, younger, emerging funds are willing to take like 1 crore sort of minimums. But as funds evolve, the minimum amount, even though is allowed by, let's say, SEBI is 1 crore, Fund 3, or the most successful funds could say, listen, minimum is 5 crore. So I think it's an evolution. But I think, absolutely to your point, I think this is an asset class that can be accessed more easily than people believe it to be, right? And I think that's where this entire domestic unlocking, newer funds, domestic capital becoming available is now making the awareness of this a lot more. I think, and things like this, a podcast like this, will sort of explain some of the simple, nuances, will actually help create more awareness.
Yeah, for sure. Yeah, after I think Himanshu, you're done explaining the LPs and GPs. We should talk about how hard it is to even run a fund. Like the glamour part aside, probably that is something we'll pick up.
So GPs, actually, I'll just draw a simple parallel. Right, everybody knows mutual funds, right? There is a mutual fund manager, right? So just think of, let's say, a mutual fund manager picking, or rather like an investment manager picking private market companies or startups, right? So that is a general partner who's running a VC fund, picking specific startups or private market companies which need much more diligence, right? And it's a completely different category. And for providing these investment services, they take a management fee and also share of the carry. Carry is the total profit pool, net profit pool that gets created, after some hurdle rate or after some minimum return, IRR return that they promise. They start charging carry, and they take they start charging some part of the total net profit that gets created. Right. So that's how you should think of how this entire construct gets created. And I think, like Ankur, you were mentioning in the beginning, right? Running a VC fund is actually dhanda, right? I mean, it's not really like you have to think through all of those aspects. It's about actually creating a business, running a business while you're running a fund.
Right. And then you have to run multiple businesses for your portfolio as well, right? You are involved in those businesses as well, depending on how much you can be involved. But the good funds actually, they have a team, but you still have to figure out these 7 businesses or 8 businesses are mine, and you might be splitting between the founding team, but you still have to figure like how to help them grow as well, right? So it's not an easy business, and definitely I think Ankur can also talk about that, and maybe you can give a perspective, Himanshu, from what you see as fund managers, how hard it is to even get started. So just to conclude that GP, I understood what you said, but for to be a GP, you also have to invest some money in, to start a fund, or you can just take the money and just manage the money. How does that work?
Yeah. So SEBI
So-
sets aside a minimum of 2.5% or 5 crores, whatever is lower, is what you have to invest if you are setting and running your AIF, right? With alternate investment fund, which is actually the only permissible vehicle if you were to run an investment vehicle and invest into private markets.
Okay. So
And-
as a single
and
GP, you
that's
would
like-
need that money.
So basically, and the thinking is simple, that if you are a professional money manager earning management fee, you need to have adequate skin in the game to be able to demonstrate that you are in this for the long term as your investors are. And that's why these limits are set. So like for example, in our fund, while we are mandated by SEBI to put in 5 crores, we invested upwards of 20 crores of our own money in the fund to really demonstrate, equal skin in the game, as compared to our investors. And I think it's super critical because outside of just the signaling to investors when you are raising, I think it also sort of aligns, interests more strongly for you with your investors, right? And I think and that's the reason that the SEBI has tried to put these limits in so that it makes the discipline a little better. I think on the GP pass, I'll just quickly. There are, I would say, outside of fundraising, which is a very important part of any founder, right? Be it a founder of a fund or a founder of a company, there are 4 or 5 core things that a GP is expected to do. Right? One is sourcing, because I think sourcing is the single most important part, and that means the companies that come and talk to us, the networks that we create for companies to talk to us. The second core aspect of that is picking. Right? As I was telling you at the start, we see 300 companies in a month. Right now, that's fine sourcing. We're getting a lot of deals, but if you have to spend time on 300 companies in a significant manner, there's not enough time, in a year to be able to do it. So you have to pick. You have to pick basis themes. You have to pick basis negative themes. You have to pick basis things that align with the core principle of why you operate, right? Your investment thesis, etc. The third is winning that transaction or winning the deal. Right? And winning basically means that you have to make sure that you or other funds are competing for it. You find a way to be the fund of choice. You get an allocation and you close the deal at the terms that you want. The next one is really, the value add, the building piece, right? Once you've invested, building a business to the point that you're spending time with founders, helping them, in their 0 to 1 and beyond journey, using our network and opening our entire network flywheel to sort of create value. And the last thing, which is actually the most important thing in a VC's life, is exit. Because at the end of the day, as Himanshu rightly said, a GP does not make any money unless he is able to create returns above a certain threshold, which allow him to take a share of the profit, right? So I think, this is one of those things where entering is easy, exiting is the hardest, because, creating returns is the biggest part of the business. So that's really what a GP life cycle looks like, and this evolves and changes, through multiple funds, etc. But these are the 5 core aspects that never change in the life of a GP.
Yeah, so basically you had 5 crore rupees between the 3 of you when you started Peer Capital. Is that how it starts usually? You need that money as well, apart from committing to all those things that you just mentioned.
What you have is not important. You need to commit it because that's the requirement. But as I said, we've committed 20 crores, and we were clear. And as Himanshu rightly explained, this is not on day one. It's over a period of time that you need to contribute. But I mean, yes, you need to find that capital. For you, emerging managers, first-time funds, always harder, right? Because you don't have spare change lying in the cupboard to be able to do this. But as you evolve, as you go into later funds, because fund 1 returns, fund 2 returns, so you have more capital, etc., to be able to do that. But yes, you need a minimum net worth to be able to commit to be able to get into this business.
And since we're talking about, I know there are a lot of steps which will go towards opening your fund. So, but let's use this discussion as someone, like we used the previous discussion for someone to invest into funds, someone who has the money. But let's also try to inspire people who can actually, become a fund manager, right? Maybe thinking, how do you get that initial money, right? Because that money you commit, even if it's 5 crores, in your case it was 20 crores, but you don't have that with you, right? So how do you even source that? I mean, what do? You can't raise a friends and family round for that, right? Like founders can still do that. So it's more harder to even get that kind of money. So that conviction that I really want to do this has to be there, not for the glamour of it, actually for actually raising that much money.
Yeah, so I mean, let me go first, and Himanshu will have many more war stories given he's seen broader set of funds itself. So I think this is not a glamorous business. This is a fairly hard business. This is a business that you can get into if you are willing to commit 15-20 years of your life to, right? This is not, and I'm saying at a founder level, and I don't mean it at a, and even there too, because thing is very simple, right? I think the economics Himanshu is rightly explained, but outside of economics, the fact of the matter is you invest in a company at this stage, at a startup stage. By the time you start to see money, it's 6-7 years from when you invest, which basically means you are not seeing any alpha return come to you during that period, right? You have to stay wedded to that fund and to that company. You have to build alongside it, take the ups and downs, and sort of be prepared to have the same challenges that a founder of your startup has, because you live it along with them. You have no choice but. So it's not a glamorous business. It's a fairly hard business. A lot of people who don't know the asset class and don't know this thing, it's a very easy business. So I can tell you, it's not. You made the right point and use the right word. Get into this business, or if you're fully convinced that you have the intention and the wherewithal to sort of work with businesses, with different type of founders, with different DNAs over a long time to create returns. If you're a founder of your own company, you have to deal with certain set of investors, but that's pretty much it. But you still have to build. I think both business. I'm not saying one is more difficult than the other. This is equally hard. Is the limited point I'm making. I think to the aspect of capital, to the minimum capital part, you obviously do have ways and means in which you can. First of all, you have to make a commitment. You don't have to put the money down, but you have to make good on that commitment, obviously, because SEBI mandates it and you will need to do it. You can do friends and family. There are certain classes of units that get allocated, which can be attributed to your contribution of 5 crores in the example that you took, which can come from your immediate families or the way it's defined. It can happen. There is very similar. There is lending and options like that available. So I think it can be done, but fundamentally, if you don't have it and you want to do something like this, be super convinced, because this is one of those places where outside of your time, which you do as a startup founder, you have to on day one commit skin in the game. And if you are weak-hearted about it, don't get into the business, because this is a great business. It's a very enjoyable business, but it's a hard, long business to be able to create success for. And truth be told, I think we are still in the early stages as a country in VC and in the venture ecosystem. So what's happened in the US will take much more time for it to happen in India. So don't be storied by that and believe, go blindly in. But I think Himanshu will have more war stories. I think he's seen many more fund managers, especially emerging ones who come into this.
Now what's next in the journey of becoming a fund manager? Next challenge kya hota hai?
I think he's beautifully pointed out the GP journey. I think even before you start, or if you've started, you've raised capital, I think you have to be very sure of the differentiation or the USPs that you have on origination, picking, and finally getting the allocation. These three things are super important. Then there is a long period of 5 to 7 years of harvesting that deal, working with the founder, building it, increasing the valuation, and then the exit, right? Basically, as a fund manager, you have to ensure how are you creating that USP. Let's say origination. What is your origination mode that, let's say, the other hundreds of other fund managers, let's say in your own vertical or early stage, mid stage, whatever that stage is that you are focusing on, they do not have that. So you have to find your mode in that, and then after origination, how are you a better picker than the other fund managers? So I think a lot of this, let's say if you are a listener and you are thinking of setting up your own fund, I think asking these questions upfront, even before you commit the next 10 years, commit the capital, that will be really useful. So I've seen personally I've seen a lot of fund managers who have spent time as, let's say, growing from analysts to associates to principals in other VC funds and then setting their fund, who have spent a lot of time at institutional investors, right? And then actually setting up a fund, because see, either you have to have some of the other advantages, right? A lot of people actually who have been part of VC funds, they have also a good network of LPs or people who would want to trust them when they set up their fund and come in as LPs. So they've developed that network. So you actually develop such, I would say, USPs and advantages if you are part of the ecosystem or if you actually work with the right set of people. So I would say just question on yourself on those fronts while you're starting, and that will actually make your life easier, right? And actually answer some of the questions that you're saying, what next yourself.
And
But
I think
the
Chetan,
next
if I can
right
add,
next step is
yeah. Sorry, if I can just add to what
No, no.
Himanshu is saying, Chetan, I think, and you asked that question as well. I think fundraising strategies for emerging managers, especially, there are only two ways to do this, right? One is you try to go out and lock in an institutional investor first, and then you go out and look to get other pools of capital. The other obviously is to do it the other way around, where you get other pools of capital, get some momentum, get your first close done, get a minimum viable product effectively by getting a certain size of money, and then you go out and do institutional capital and raise money. Right? So I mean, I'll give our own example. What we've done is we've just pretty much followed a lean startup type approach, right? As we were building out Peer Capital as well. We first went to people who knew us from the past, who had clear trust and conviction in us as individuals, and we raised certain amount of capital from them because it was quick, it was fast. Diligence and conversations in this are more conversational. They happen sort of in quick time, and the moment you are able to get certain amount of commitment, you can actually do your first close, which means you're in business, and you can start investing very quickly from there on. And then then we use the opportunity to go out and build our institutional case, right, and go to institutions to raise capital. I think the institutional part of the process is fairly detailed. It takes months in many cases where institutions need to get comfortable with who you are, same things that we ask startup founders, right? What's your right to win? Why you? What are you going to solve? How are you going to solve it? I think Himanshu rightly articulated about what's going to be like, sourcing is a big thing, other elements. So they spend a lot of time diligencing it. They look at your past record. So like in our case, they looked at, Karthik's record as an institutional investor, Rohit and my record as angels, and the returns that we've created. They got feedback from the companies we've invested in. They got feedback from our existing portfolio, etc., etc. So I think strategically you have to make a choice basis what your network is. If you believe you can do a lean startup method and try and get reasonable capital from friends, family, ecosystem that and do a minimum viable commitment and therefore do a first close, that's one strategy. If you don't have that network and you want to go the institutional way to create a minimum viable commitment and therefore do a first close, that's the other strategy. Both strategies work. I think fund managers need to choose which works better in their case, and then decide. It also, by the way, varies from type of fund, right? And what I mean by that is a micro VC can follow a very different approach. A classical VC will follow a very different approach. A PE has no choice but to go to institution because they can't do a close at 100 crores and be a growth fund because there are only those many deals that you can do. So I think it varies, but I think both approaches work. We preferred lean startup. It was the most efficient way out of the blocks, gave us the opportunity to capitalize on the great opportunities that came to us from our network, and I think we've really reaped huge benefits, by being able to do that.
No, that's great to know, guys. I think overall, anybody trying to think of it would obviously now hear this conversation and at least be able to plan this better. And thanks both of you for really valuable insights, because I obviously felt that this can be very educational, but this is really great that you're telling the nuances as well, not on the high level. So thank you, Ankur and Himanshu, for that. Since we're not in the car, and obviously wahan pe to we have fun in other ways, we also used to sing, but I want to keep this last 10 minutes very light-hearted, more on personal life more than anything else. And we can pick up the topic of keeping that balance, right? A day in a life of Ankur or a day in a life of Himanshu. How do you unwind on weekends? Just know a little bit more about you personally. But with a twist, we'll also play your favorite song in the background. So on a lighter volume. So that song is playing while you are talking about your day. Ankur and Himanshu, any song that you usually would sing with a glass of scotch or whatever on a Friday evening at home. Would love to hear that song. Anybody wants to go first?
Ankur, why don't
Yeah, I
you
think-
have been a victim already?
So as long as no, but he's not making us sing, so that's the easy part. I think just talking songs. But I think with a glass of scotch or any other poison. I mean, I like more jazz, etc. But the song that I think would be, because to give the, I mean, Karnama, but there's no car here. But I personally like Tracy Chapman's Fast Car. I think it's a meaningful
Oh, lovely.
meaningful song. So,
Yeah, very meaningful song. Let me
so,
play that while you talk about how your day or your Friday evening usually is. Let me know if you can listen in. Hold on a second.
Maybe I picked this song only because of the Karnama and car reference. But look, I think I'm obviously grew up in the 80s and early 90s where MTV had just come to India, right? And us time Grammys and watching the Grammys and all was a big part of entertainment because there was no OTT. Doordarshan and all had very little channel, and cable was expensive, right, to get. So you had a few channels. So MTV was obviously the source of core entertainment for me, and that's how I got more used to Western music. So I just remember this from one of the Grammys, and the car reference came through.
And what does a Friday evening and with scotch looks like in general?
Yeah, I think varies. I think on football game nights, it's a very different thing. I think big Manchester City supporter, so EPL is
Oh, man.
is on.
Good, you did mention it before. I'm a big Liverpool fan, so
Yeah, no, I do feel sad for you, but it's okay. I think it's fine. Being a Liverpool fan has its. I think they have to be brave hearts, right? So I mean, commiserations, but that's okay. So I'm a big Manchester City fan, and
Since when?
since the last 5 years. So maybe because of me becoming a fan, they won last 4 years. I like to believe.
If you're lucky.
True.
Maybe now.
You
But
guys
yeah.
are like United fans, right? When the popular club, right? But I'm just kidding. Do you like the football in general, or you are more a Pep fan?
No, I think I like the football in general. My favorite player is actually Kevin De Bruyne, and therefore my favorite country to watch is actually Belgium. So it's nothing to do with Pep per se. But I love watching football. So I think game nights. I think Fridays and Saturdays, that's the best thing to be able to do. I think other than that, I think, as I was saying earlier, for me, and this is not just Friday. I think I really focus a lot on getting a good night's sleep, right? And I'm very, very anal about making sure I, and that's why all these trackers significantly help. Look at the quality of your sleep, and as I was saying, my caffeine tapering, my meal intake timings, I watch quite judiciously. So I mean, I'm more focused a little bit around sort of health, longevity as a consequence of good health and good sleep. But I think game nights are game nights. If there's no game nights, then some good jazz music and jazz and scotch goes well. Spending time with the family, meeting up with friends, and just being able to really unwind. I think it's super critical. And I have a pet, as I mentioned earlier, so just keeps you occupied and busy with kids as well. So yeah,
Oh yeah.
typical Friday.
And I'll take your jazz playlist for sure. I've tried a few times, but until you get the right kind of playlist and mood, or maybe the right scotch also helps, right?
And the
And the right company. Maybe
shorter
which
ride.
order I
And the
don't
right
know.
company. Yeah. Maybe next time we meet, we should do that. Awesome, great to know that, about you on your personal end as well. Himanshu, what's your favorite song? I would like to play it on my phone so we can listen more clearly this time.
Yeah. So see, Friday nights, like Ankur, I think for me it's always the family time, right? It's a little bit of unwinding, and in some of the cases there are friends over, right? So and actually when I'm with my wife, we are in love with the movie Notting Hill, like very old school there.
Oh, nice. It has a very
we've
nice
seen
song.
it, like-
So I'll play the song this time because there's a favorite song of mine from Notting Hill.
Yeah. Which one? When You Say Nothing at All, or
When You Say Nothing at all.
Innocent.
Yeah.
Remember
Yeah,
that
yeah.
guy he used to come in a band when we used to listen I think Boyzone or what?
Yeah, Ron Keating.
Yeah.
Ronan Keating is the singer. Yeah.
Yeah, very nice
Yeah.
song.
So
Yeah, it's just about, actually Friday nights are always about, it's always about unwinding. I have a small one, a 5-year-old son, so we listen to his stories from the week. We also like we are also like travel buffs. We travel a lot, and sometimes these are impromptu plans we make and just leave over the weekend.
Oh, I love
So planning
impromptu.
for the
What was the
weekend,
last impromptu plan? Now we're talking.
Yeah, I think Bhimtal was the last one. Just took the on a Saturday morning, early morning left, and
That's
going,
nice.
I think
Bhimtal,
next
Satal,
week-
did you do both? Bhimtal, Satal, they're...
yeah, we went there, like Delhi ke aaspas jitne bhi all the hill stations etc. We've done so many times, right? Up to we've done all those places.
So
For a
we should have
moment,
said that.
Sorry, for a moment, Himanshu, when you said drive, and we were discussing Friday, I thought you meant the 3-hour drive on a Friday evening between Delhi and Gurgaon. Sorry,
What
Get
a
this enough.
timing, Ankur. I was actually gonna say that see, we have hills around and we can actually go and drive. You don't have that much in Bangalore. Not like big hills, but yes, of course, Bangalore around is beautiful. But this banter probably unfortunate. I had to get on to this webinar thing, but would have loved to keep this going. But hey guys, this unlike Karnama where we need time and effort and everything to get you together, something like this, whenever you're next in town, Ankur, we can actually do a part 2 as well. So because we had some really good conversations today, and thanks a lot for taking out time. I know we were trying to get your time, and I hope you liked the setup. I mean, it's still
I loved it.
Thanks so much. Loved it. Yeah. No, I think maybe if Himanshu and me can be, or anyone can be in the same room, I think the banter again is very different. This is so. If you are ever able to get everyone in the same
we'll
room,
try to do that. The only reason there we didn't do that, because I was here, so I was like, if you guys are together, I'm here. I don't know if it'll get an awkward setting, but you both should meet. You're not very far from each other.
We'll just catch up after this.
So yeah, do catch up, and feel free if you need any other help from the team. But yeah, signing off today. This was a really good discussion. I hope you also had fun.
No, absolutely.
Yeah,
Great.
well,
Thanks for having me. Yeah. Great fun.
Great fun to do this.
Great guys. Okay.
Thanks, Chetan.
Take care.
Thanks for your webinar.
Thank you so much. Bye bye.
Thank you.
Thank you.
Okay,
Have a
Uncle.
good
Cheers, bye.
Bye. Take care. Bye, Manshu.